Understanding why individuals lose money in the stock market and how to avoid these pitfalls is crucial for achieving investment success. Let's dive in. One of the primary reasons for the underperformance of many financial advisors and professional money managers is their short-term focus on relative performance. This short-term orientation is also observed in individual investors, driven by emotions such as fear and greed. Emotions like fear and greed significantly influence short-term stock price movements. Investors often desire quick gains, but building wealth takes time. The key principle is well known: buy low, sell high. However, in practice, few adhere to this strategy. Investors tend to become greedy during market upswings, buying stocks to avoid missing out. Conversely, during market declines, fear sets in, prompting selling in anticipation of further losses. This behavior, illustrated in the graph, is detrimental to returns. Hype and pessimism in the market are fueled by constant exposure to financial news, analyst predictions, and stock tips. The abundance of information, while informative, makes it challenging to maintain focus and avoid succumbing to prevailing market sentiment. A valuable approach to mitigate these risks is to ignore the news altogether. External events such as interest rate changes, geopolitical tensions, or unexpected developments are beyond an investor's control. Instead of worrying about uncontrollable factors, concentrate on buying solid companies at discounted prices. The historical performance of the S&P 500, despite enduring significant events like the Great Depression and World Wars, emphasizes the importance of a long-term perspective. Though market fluctuations can be unnerving, reacting emotionally to price declines is not a rational strategy. Instead, view price declines as opportunities to acquire quality assets at lower prices, provided the drop is due to fear rather than fundamental issues. Warren Buffett's timeless advice to be fearful when others are greedy and greedy when others are fearful aligns with the idea of approaching investments with logical reasoning, akin to purchasing physical products. Your emotional reactions should not be swayed by market sentiment. Rather, focus on the financial strength and valuation of the companies in your portfolio. Avoid emotional attachments to stocks based on popularity or news coverage. Whether it's Google, Tesla Motors, or an obscure company, prioritize financial health and bargain prices over brand recognition. Herd behavior, driven by fear and greed, often leads to mediocre returns. Investors must resist the urge to follow the crowd and think independently. Buying or selling based on short-term price movements, without considering the underlying value, is a common pitfall. Context matters when assessing whether a stock is priced low or high. Comparing current prices to historical prices is insufficient. Instead, evaluate prices relative to the intrinsic value of the underlying company. This approach counters the illusion of buying low when a stock's historical price is lower but its actual value is questionable. Technical analysis, relying solely on historical prices, is discouraged by influential figures like Warren Buffett. The emphasis is on fundamental analysis that considers the underlying value of a company. Lastly, the frequency of trading significantly impacts transaction costs, often underestimated by investors. Infrequent but substantial investments are recommended to minimize these costs, aligning with the advice of renowned psychologist Daniel Kahneman. All of us would be better investors if we just made fewer decisions. To sum up, success in investing involves overcoming short-term biases, managing emotions, disregarding market hype, and focusing on the long-term fundamentals of solid companies. Make well-considered, infrequent investments rather than succumbing to the pitfalls of frequent, emotionally driven trading. Thank you for taking the time to explore these valuable insights. Warren Buffett's wisdom offers a roadmap to navigate the complexities of the stock market. As you embark on your investment journey, remember to stay mindful of emotions, prioritize long-term fundamentals, and make well-considered decisions. Don't forget to hit that subscribe button to stay connected with future insights and guidance. Here's to your success in the world of investing. Thank you.